Okay, making a video, economics video actually, and I probably should put it on the economics channel, but I'm not going to. It's too much work. So anyway, but I'll post a link to fair economics. So I have covered this stuff before, so it doesn't really matter. So it's redundant. People get pissed off, but I mean, people always leave these stupid commenters. So there's this guy, Chris Conway, he talks, you know, this patronizing, you need to get a better understanding. No, I don't need to, asshole, you do. Alright, your little truther bullshit is just that, truther bullshit. So he posts these links to this stupid truther nonsense about, oh, the Federal Reserve, and ooh, fractional reserve banking, ooh, scary, scary. And it's just such a crock of shit. I mean, nobody wants to admit what the problem is, which is borrowing money isn't a good idea. Duh. It makes the rich richer. Duh. They don't need to steal your money. You're willing to give it to them. Idiots. So anyway, so let's go through this again. Alright. The only choice besides fractional reserve banking is gold standard type banking. Okay, which basically means is you always have an asset locked up somewhere. Okay, saying this is the loan, this is the money, blah blah blah. And it's just stupid. So the game would be is that what a bank would do is a bank would sit here and it would have gold. Well, they would have the money. And what people would do is they'd bring gold in, right? They'd bring a hunk of gold in and get some money out. So a hunk of gold would sit in the bank and just rot in there. And just say, I'm a hunk of gold sitting in a bank. And all loans could only be, taken out based on whether the bank had actual gold in here. So if somebody came in and got some gold from the bank, some money. Sorry, don't let me confuse things. Okay, so somebody comes in, gets some money out, and puts some gold in. So now the bank has some gold. And so now it can loan the value of the gold to somebody else in terms of making a loan. And but the problem with that is that you're already getting fractional reserve-y, right? Because somebody else already put that gold in. So it's already somebody else's money, technically. But anyway, this whole idea would be is that only the money coming in could finance loans going out. And so you're completely limited in terms of how much available money there's going to be. So another way of looking at it is you could take, like, say if you're going to restart a currency, you'd create a system where you'd say the value that exists is the value of everything. And you'd monetize the currency based on the value of everything. And that would be the total. So you'd make a total amount of currency and you wouldn't print any more ever again. Technically. And that would be the pie, right? And so you just have pieces of the pie segmented into these little pieces that represent the value. And you basically tell somebody, look, you want some cash? Bring in a piece of your pie. Okay, we've assessed your pie. Bring in a piece of pie. Okay, give me your mortgage. Give me your something of value, and I'll give you cash in return for it. And then at any time you can come back and get your valuables. So it's like a pawn shop. Yeah. But again, so you're limited to the size of this pie, and as soon as those resources start getting thin in terms of the amount of stuff going in, there's no money to be borrowed, and so interest rates go. The owners of the surplus, right? The owners of this pie are the ones who are going to be the ones controlling interest rates. And so if there's high demand for their money, they're going to be like loan sharks. They're going to kill you, okay, on interest rates. So you'll pay twice or three times the interest for money you borrow if you don't have fractional reserve banking. So all fractional reserve banking says is that, look, if somebody wants to borrow something, just take in some collateral, okay, take in some goods to secure the loan, and then it really doesn't matter how much money you loan out as long as they're collateralized loans. So as long as you're getting stuff in, yeah, put out as much as possible, as long as you're getting value in. So it's all about collateralized loans, which aren't insane. And the uncollateralized loans, at least for the consumers, are the ones where they charge a 33% interest and stuff. So obviously they're making, they're able to finance the failures. But the problem is that the one downside is of this system is that you do create more buyers in a market, and so because they're buying on borrowed money, and so it does bubble prices, so it inflates prices because more people are buying stuff on borrowed money, which means they have to pay interest, which means somebody's got to pay the interest. Some new piece of pie has to be created to pay that interest, and if a new piece of pie isn't created to pay, like if the economy doesn't get bigger to pay the interest, then the interest has to come out of somebody's ass. It's just, there's no other way. Somebody has to lose somewhere for the interest to be paid. They have to lose wages. Somewhere they have to lose value. I'm not doing a great job of this. I was really hoping to do a little better. But the idea of the fractional reserve just means that you're able to remonetize. So it's essentially like this back here. It's just that you keep remonetizing the gold that comes in. So if somebody deposits gold, you just remonetize it when you're loaning. As long as you have money, there's got to be a better way to do it. All right, say you have a house mortgage in the bank, and so you took in $100,000. You have a $200,000 house, and the bank owns the note, so it owns $200,000, and it's only loaned out $100,000. So it has a pretty good deal here, in that, you know, a real catastrophe has to happen for them to lose, because they're already $100,000 in house ahead, if they had a reasonable down payment on the house, right? Now that's really part of the problem, is they haven't required substantial down payments to finance mortgages, and that's what's made them iffier. But anyway, so you lent out $100,000 and you have $200,000 in assets. Okay, it's a deed. It's not a it's not cash, but you might as well convert it into cash because it's as good as cash. So you might as well loan out the value of that mortgage instead of waiting for a depositor to come and give you some money to lend out again. Just remonetize your collateral, because it's as good as money, right? I mean, a deed for $200,000 on a house, 80, 90, 95 years out of 100 will be a winning asset, meaning that it'll be worth more at the end of the year than it was at the beginning of the year. 95% of the time, that's going to be the truth. So yeah, you can ride on that most of the time, and then every now and then, when everything goes to hell, yeah, it's not going to work anymore. But so you shouldn't live the other 95% of the days taking advantage of the fact that there's more opportunity. You can lower interest rates for borrowed money, which seems kind of like a good idea if people are going to borrow. I mean, theoretically, I don't think borrowing is a good idea. So unless you're investing in future infrastructure or something really meaningful, yeah, I don't think borrowing is too swift. But obviously in the world we exist in, there's no way some person could save up enough for a house, let's say, as an individual, unless somebody loaned them the money. I mean, they'd have to wait to live in their house until they're too old to give a shit about having the house. I mean, there's no point in having the house after you have your kids and all that kind of crap. It's better to have the house before you have the kids. So, there's some practicalities here where people do have to sort of be given a little more infrastructure than they've earned and pay for it later. It kind of makes sense. Some of the basic infrastructure, yeah, you kind of need a roof over your head. You need certain things. You need a car. You need certain things to get on with your life and make money. And so those investments are reasonable. The problem is that people are allowing people to borrow those assets at profit. And again, you have to figure out a way to pay that profit back. And the only way that can happen is if the economy is growing. And if the economy isn't growing, there's no way to pay the interest without compromising the value of people's stuff. You're either pricing them out of a market or pricing them out of their wages. Alright, I'm still not saying this exactly the way I want to say it. So how can I say it again? Like I said, if you were starting over, you'd get the idea of what happened, what ruins, economies. And it's not borrowing itself. It's not money, cash isn't the problem. So again, I want to reiterate that people keep having this perception that this money just can flow in some unlimited fashion, and it's not unlimited. It's limited by the fact that the bank does have to make money on it, and if it isn't making money on it, it's going to lose money on the loan. It still has to pay the money that it lends out. They still have to pay. They have to still pay the principal back. So I'll do the Federal Reserve thing a little bit more on that, because I explained it rather poorly. So you could look at here's the Federal Reserve banks again, the regional banks, and here's all the little banks, but they're mostly 3%. I mean, well, whatever it is, yeah, it's like, I don't know, 3% of the banks. There's 7,000 banks, and 3% of the banks have 50% of the assets. So it's kind of like the rich man, poor man thing, even in banking. But anyway. So here's the Federal Reserve. So what happens is the banks have the cash comes in. Lots of transactions take place. Comes into the bank. The bank gives the money to the Federal Reserve because the Federal Reserve is going to clean the money. Okay, so it's going to take out all the bad bills and replace them with new bills. And when it does that, it checks the bank accounts it has with this bank. So if this bank converted its reserve accounts, if it asked for cash to send out in loans, then it has to pay that cash back. And so what the Federal Reserve does when it's cleaning the money is it says, what does this bank owe? So it takes the money in, it says, what does this bank owe us in cash it took out? And it subtracts whatever that is. So it subtracts whatever's owed, and then it puts the money in its reserve account. So now the bank wants to make some more loans. It takes the money, it requests the money out of the reserve account to be converted into cash, and now it can distribute the cash. And so the money goes into the reserve accounts. So all the money the bank gets goes into the Federal Reserve to be cleaned. And all that the bank gets back goes into their reserve accounts. So if the bank doesn't ask for any of the money back, these reserve numbers can get high. So now they have whatever it is, the $3 trillion in these reserve accounts, when all they are legally required to have is a few $100 billion to cover their 10% reserve requirements. So they have to have 10% of cash assets relative to their liabilities. So whatever their liabilities are, whatever their extended, the money they have, how to put that? It's a balance sheet thing. The negative side of their balance sheet, whatever's on there, they have to have 10% to cover. They have to have 10% in reserves to cover that, instead of a full reserve. Full reserve banking would mean that they'd have to have the full amount. And again, if they had the full amount in the vaults, in these accounts, then obviously this money couldn't go anywhere, couldn't make loans, and it would be frozen. And therefore interest rates would obviously go way up. So, but in this environment, obviously everybody's overextended. Debt is, there's no good borrowers anymore. And, the people who are in debt can't take on any more debt. Even if they wanted to, they can't pay it. They know that. So they don't acquire it. So what else? So anyway, but that's just the catch here. It's just that I just wanted to explain that's how the money gets into reserve accounts. The banks don't put the money in the reserve accounts. They just don't take it out of the reserve accounts. So it's not a huge difference, but there is a difference. And like I said, one of the reasons they're not taking it out, I think, is because they don't want to have to declare it as a profit yet. So they want to wait, to wait till they have losses so they can do whatever that is, the tax bullshit where you don't pay taxes because you claim you lost money or some sort of crap like that. Probably something like that. There's no other reason for them to have it in there. Beyond the fact, like I said, if they kept it in their own vaults, they don't get any interest on it. And if they keep it in the Federal Reserve vault, see, if they keep it in their own vault, they get nothing. But if they do keep it here, if they let it stay here, then at least they get whatever it is, 0.25% a year or something. So they get something. Yeah. So anyway, but it's not fractional reserve banking that's ruined us. And so the part I wanted to get to, which gets even more convoluted, was theoretically this whole banking thing should work out, because you figure there's bank A and there's bank B, and you figure, that if somebody loans money, if money goes out here and a deed comes in here, that the money that went out is probably going to end up back in another bank eventually. So it'll either end up back in this bank or it'll end up back in this bank, but it's going to end up back in a bank. So in a sense, it's it just keeps flowing through the banks, and the banks just keep collecting these deeds for the money going out. So, but what's the difference realistically? I mean, what's the difference between the money artificially going in and calling this a deposit, when it's really borrowed money? I mean, it's borrowed money. It's already borrowed money. Whether you call it a deposit or not, whether you put it through another person's hands, what's the difference? What's the difference? Let's take the middleman out. Let's take the guy. So I got the cash and I paid it to Joe. Well, just to say I paid it to Mr. X, and I'll be Mr. Y, and I'm Mr. Y. So Y borrows the money. He pays it to X. X puts it in the bank. Well, what's the difference between X borrowing the money and X putting the money in the bank as a deposit? Right? There's no difference. And so the only difference would be is that he only collects a small interest rate on his deposits, and he has to pay a higher interest rate for the loan. So the bank's making money off the whip, but I mean, it's just the same idea. So this whole concern about fractional reserve doesn't mean too much. The thing that's changed banking that no one really talks about are markets, okay? Because they're functioning out here in the middle of nowhere, the stock market, and that's where a huge amount of the debt is. And it's in there in a sense that, stocks have values, and those values, it's not like stocks will go down in some kind of rational way where, like, you could own a stock right now that's worth $300 a share, and that tomorrow maybe it'll go down 50 points or maybe 20 points or maybe it could go down to nothing in one day. And so everybody holding the stock could lose all of their money, in one day. It's not like it gets pulled out gradually, and so there's a midway point where at least half the people got their money back, got more money, got back what they paid for it. But yeah, so I mean, there's just a huge potential for loss here. And this is the stuff that's all a penny on a dollar. So it's 1 cent on the dollar of value. And this is essentially a bank. It's basically a loan in the sense that people go in, they give their money, the cash goes to the rich owners. Technically it goes to the business, but who cares? The business doesn't have to pay back anything to the shareholders. And the only value in the business having the money that the shareholders paid in is that hopefully it'll prevent the business from going bankrupt, but there's no guarantee of that. And so what the shareholders basically have done is they've put their money in the stock market as if it's a bank, and they're collecting interest. But obviously the assets are crap. So at any moment they can turn to nothing. All right, but they're paying a very high interest because there's plenty of people making money off loans. Okay, so they have money to buy the stocks. They have so much money they can't loan the money to other people, so they just buy these stocks with it. And the stocks just keep going up based on these IOU money. But that's the place where you can clean it all up. Once these things crash, once they go once they're dead, that kills a huge chunk of the debts. Pretty much. And obviously the businesses go back to their regular retail sale price if they don't go bankrupt. But if they go bankrupt, then that's all, huge unemployment, and that's a whole cycle that just feeds on itself too. I didn't explain that as well as I wanted to either. But because the stock market is essentially a bank, it's just a bank that has crap as collateral. It's a lot worse than fractional reserve banking is the stock market. At least banks, most of the loans, outstanding, are collateralized loans, meaning they have assets for the loan. Now, some of the assets are shit, like stocks, are other assets that won't have any durable value, but most of them are pretty durable assets. So they are collateralized loans, and the bank shouldn't lose any money in a default. Yeah. Theoretically. So the only problem with fractional reserve banking is the fact that, if you live on it, that means everybody takes advantage of it, and the lower interest rates, it will create inflation. And so that's what you got to guard against. Yeah. But it's not the cash that's the problem. Like I said, it's only the cash always goes back. This cash cycles back in. And the Federal Reserve decides how much of this cash is out. And at any time, it can just decide to buy back it can go, put one of its bonds back on the market that it bought, or do something else to get the money back in to compensate for what transactions it's made. So it can control how much cash is in the economy at any one time. So it's not the cash that's the problem, and it's not fractional reserve banking that's the problem. It's the idea of borrowing money and paying interest. That's the problem. It makes the rich richer, and the rich have gotten preposterously wealthy, and everybody else is a renter, and that's the problem. And humans are not very valuable anymore, because machines can do their jobs better than they can. And that's the real problem. I mean, the real problem is that labor isn't worth anything. And if you're not an owner, you're fucked. Yeah. Because you're just not going to earn enough money as a worker to go anywhere, to get anywhere. You're not going to get unburied. Okay, that's enough. Yeah, I didn't do it as well as I wanted to. But, shit like that happens.